Good morning, everybody, from a snowy south coast here in the UK. Bit of a surprise to take the kids to school this morning, and it was snowing quite hard. And I know some of the other guys and girls are seeing some of the white stuff around as well. K-Man, are you here? Are you here? Hello, hello. No, he's not in yet. He must be snowed in where he is. Anyway, so we shall crack on with things. Anyway, lots to talk about today. Always. Oh, there he is.
Hey, good morning.
Get snowed in, mate.
It is snowing. It feels like I overslept twice. Once this morning and once for our show here.
Oh, I'm gonna have to put you in detention, mate. give you 100 lines to write. The old days. Right, let's get stuck into it. Quick look at the PBOC. They set again their rate at 710 in the 710-18s. So keeping that going on there. However, we had some data out overnight. We had a bit of data out from everywhere, really. But we start with the Chinese data that was out overnight. PMIs. Now, these are the official PMIs rather than the market S&P Global ones that we get normally for us over here. Manufacturing going further into contraction was expected to actually rise to 49.7, came in at 49.4. Services as well going backwards again, was expected to rise to 51.1, but came in at 50.2. So as I've been saying, China still not out the woods as far as their data goes, but no real move in dollar China on that. I was expecting to come in and find it a bit higher. But it wasn't, well, nothing significant. I might have expected it to be up above this zone again, but it wasn't. So maybe now officials have got the currency moving their way. They can keep a little bit of pressure on just to stop it from ramping back up. But either way, not good data out of China. Apparently, according to Bloomberg, the China Investment Bank has put a ban on bearish research and displays of wealth from them in China. They don't want banks, institutions putting out bearish notes and research pieces. They also don't want bankers flaunting their wealth. That's something that I don't want the rest of the masses to see, that people are making, yes, exactly, Brian, communism for you. I don't want the rest of the population seeing all these bankers making money off of their, well, I wouldn't say hardship, but let's call it, it's never as prosperous on the ground as it is in the banking world. So anyway, just more squeezing by officials there. Over in Japan, the Ministry of Finance issued its latest monthly report on FX, and there was no intervention between the, I think it's the 30th of October and 28th of November. So they did nothing last month as far as intervention goes. Data out from Japan as well. Let's go back a bit, see where it all is. And some better news. Industrial production coming in a positive. Where are we? There we go. Industrial production. Oh, I've got to find it. There we go. 1%. Month on month versus 0.8% prior. Some of the forecasts are a bit mixed. 1 month ahead dropping, 2 months ahead up, but don't really worry about that. Year on year, also a positive number, up 0.9% versus 0.4 expected, and a prior of minus 4.4. So despite us seeing a bit of weakness in the manufacturing PMIs, at least for October, industrial production looking a bit better. Retail sales, however, looked a bit soggy, down 1.6% month on month. Year on year number as well, not coming in as hot as expected, only up 4.2% versus 5.9%. So a little bit of a mixed picture in that. BOJ board member Nakamura said we will need some more time before we can modify easy monetary policy, and says that current inflation is mostly driven by cost push factors. However, we are seeing signs Japan will see wage growth exceeding the rate of inflation. But I guess that depends on which grows the most and which falls the most. If inflation comes down while wages grows up, then obviously they'll see greater wage growth, real wage growth. We shall see what happens into the new year with all that. Just looking at some of the other data, there's a few bits and pieces out from Australia that I won't bore you with. Some other bits and bobs. Household confidence in Japan ticking up as well there. We've had a lot of CPI data and some final GDP numbers coming out of Europe. France CPI, HICP coming in lower than expected following the Germans. That came in at 3.8 versus 4.1 expected. As you can see there from their own CPI number, that's dropping as well. It's been a bit of a theme this morning. We had our mate Christophe Barod from Bloomberg putting out his expectations that CPI was going to come in lower than expected for the headline numbers, and that's done a bit of damage to the euro this morning. As I say, going through some of the other numbers, Germany saw a little bit of respite. Retail sales coming in fairly positive on the month and less crappy year on year, up 1.1%. So maybe some early holiday splurging by the Germans. However, on the other side, unemployment rate ticked up to 5.9% there. Italy as well, its unemployment rate jumped quite a bit, 7.8% versus 7.5% expected. The prior was 7.4%, and that got revised to 7.6%. Italy CPI numbers as well dropping down. We're now below 1% for their CPI number, 0.8%. Same for the Eurozone measure year on year, 0.7%. Could we see some of these countries heading towards a bit of disinflation or deflationary negative CPI numbers? It might be possible. Those Eurozone numbers there as well coming in lower than expected. Core CPI 3.6 versus 3.9 expected prior, 4.2. Headline CPI also 2.4%, creeping closer to near the ECB's target. Is that going to cause them to turn a little less hawkish and hear more chatter about cuts coming? I think it's too soon, but you never know. So big numbers there. What did you make of all that, Kay? Bit of, I think we saw a couple of things from the euro. We saw probably a dissipation of all the month-end stuff, and then the market doing a bit of a reprice on ECB expectations on the back of this.
Absolutely. And you know, this is something that I've been talking about in the chat room. And my impression was that the Eurozone was going to catch up. And it's been a bit the case in this whole pandemic era, let's put it that way, where we're getting out of it, of course, but let's rephrase it. In the whole inflation environment era that we saw the past 3 years, it's always been coming with a delay in the Eurozone, and we are seeing it again. We have seen, of course, all numbers have been coming down, but now we really see misses in the Eurozone compared to expectations, right? Where we had, sorry, this more of this scenario was rather seen in the US, and the rest being a bit stubborn, as we also see in New Zealand and Australia, where, well, now Australia printed a lower one, but up to now they were a bit more stubborn. US was more dynamic, but now the Eurozone is really catching up. So I think it's a combination, as you say, of everything. I mean, we've done a lot over the month. It's been a big month for equities. It's been a big month for bonds. There has been or there is still need for rebalancing back into bonds as well. So that's been depressing the dollar rates as well. And now we are seeing this catch-up move in the euro, and that's where I think that we are seeing now. We're seeing several of the euro crosses being finally a bit weaker, and I guess that's a scenario that's going to to be in the markets for a little while now, perhaps like once our fixings are over today, because we never know how much is still left to do. But once the fixings are over, I guess that we might see a bit more euro weakness in one or the other area, just as a catch up on the US block, because the people are having to reprice what's well, repricing is always a word I don't like to use, but people need to manage their books compared to one block compared to the other, right? And that I think we may see for creep into the market. Started yesterday, I guess, because then we had a bit of negativity or dovishness from US FOMC members, but the dollar stopped coming down. So I guess that, as you say, a combination of everything. We'll see what the day brings today. But I'm looking at the euro with a bit of a weaker eye, like right now, you know.
Yeah, and I think what probably is going to start creeping into the market now, particularly for the eurozone, seeing inflation now at 2.4%, is whether it's going to keep going. If inflation in the eurozone comes under 2%, that's bang on the ECB's target, close to 2%. If it starts moving lower, the market might get a bit excited that it's going to keep going, and then the ECB are going to be very forced very quickly to turn from just bringing rates down to a neutral level to actually having to cut to get inflation back up again. It's almost like the elastic band snapping.
Yeah.
We've gotten on the higher side now. If it comes down to 2.2% and stays there for 3 to 6 months, they'll be happy. If we start seeing it going under 1.5%, 1.4%, the market's gonna start thinking, well, now they've got a job to do on the other side, and that's where we get the excessive dovishness coming in. But something we got to look forward to.
Yeah, and the doves will also come back out of the woods more vocally, right? I think instead of doves and hawks, we should now call them like holders or folders, because I think when we see those numbers, when you see the economic data on the side, they're done, right? I mean, there's nothing in there. I mean, if you look at the Eurozone inflation now at 2.4%, where does it have to go to for them to hike again? Because don't forget, they are at like 4% or so, right? We're coming back from, let's not forget that we're coming back from November 2022. The Eurozone inflation hit above 10%. And now we are, and now we are at 2.4. It's actually a much faster decline than we have seen in the US. So that to me adds to my feeling that the ECB will likely become more dovish than the Fed faster, which is a bit of a change, because usually the old continent is slower than whatever moves in the US. But this time, I think it does look like the Eurozone or the ECB, let's say, should be more dovish than what the US is, because of the speed of this coming down. Of course, it's also more complex than 15 years ago, the old continent, because you had more members, and more members creates more volatility, right? So, but I mean, this if you look at, I don't know if we can find the comparison with the US, but it's a lot faster, this move lower than what's happening in the US, and that I think is going to keep at least the bond markets saying that the European rates will stay lower than the US rates, whatever happens in 2024.
Yeah, exactly. I think I've
Should
got,
at least.
there's the US inflation number. So yeah, 3.2%.
Yeah,
where they were
so
2.4 in the
we're
Eurozone. Yeah.
going from a number higher in the EU at the end of 22 than where the US reached, to a number which is now lower. So the acceleration has been faster in the EU, and I think that somewhere, well, in my view, at least, should weigh on the euro via yield expectations and things like that.
Yeah, so here we are, folks, right in the middle of the race to cut, and now it's the euro's turn for its horse to sprint a bit forward ahead of the others. But anyway, we should get back into the pricing in a moment. Get through the rest of some other headlines. Bailey was out and with some Christmas cheer for everybody, saying he's no pessimist, but the UK outlook is the worst he's ever seen. Thank you very much. Merry Christmas to you as well, Bailey. Only another 10 years of
Incredible.
at the helm. There was also a Bank of England survey out, business survey out, which saw CPI expectations for the year ahead coming down to 4.4 from 4.6%. So going the right way, but still obviously quite high. RBNZ Governor Orr was out pushing the message from their meeting again, saying we are concerned inflation won't slow fast enough. We are in no mind to cut rates anytime soon, though. The ECB, EconoStream, our mates at EconoStream, also out with a piece saying that they will discuss, or apparently will discuss, whether they're going to end PEP bond reinvestments. That discussion might come as early as the December meeting. So it's something that's now gone on the docket for expectations for that one.
That was kind of what they were hinting at, right? The surprise would have been if they would have discussed it at the prior meeting, but December was always penned in to have at least the discussion around the PAPP, right?
Yeah, I'm wondering if it's going to be one of those. We are going to discuss it at a future date, but we're telling you now we're going to discuss it at a future date, or that discussions have begun. I can't see them making a decision at this meeting, so it's probably going to just be a confirmation that they are going to be discussing it to do in the new year.
And Lagarde already said that. I mean, they can have the discussion and even make a decision, but she said that the reinvestments are penned in for 2024, right? So they will be discussing stuff which should be happening either end 2024 or 2025, even if I understood Lagarde well.
Yeah, potentially. That could be the case. And just in case you see any headlines, there was a headline that they're stopping all their PEP operations and whatever. That's just the annual holiday period stoppage of such things. They'll be doing that sort of second week in or third week in December through to the new year, because obviously there's not much going on in the markets. So things like reinvestments and all their other programs will pause. So it's not a monetary policy move, in case you see those headlines. It's just a mechanical move for the time of year. Right, coming back to the data and yesterday's GDP from the US. Now, we should always bear in mind this is the revision, so it's further and further in the rearview mirror, but it's still surprised, and we do get further data that we didn't get in the flash numbers. So the headline GDP bumped up to 5.2%, going great guns on that. You might think, oh yes, the dollar is going to rally 100 pips and yields are going to go higher, which was not the case. Some of the underlying numbers, though, that we just found out got a bit softer. For example, consumer spending missed expectations, coming in at 3.6%. Core PCE came in a little bit softer. So there is some things that are good and some things that are bad. Corporate profits came in strong, 4.1%. So that's on the good side. But what the market is looking at is obviously inflationary pressures, spending pressures, and that's took most of the wind out the sails of that good number on the headline there. We also got the beige book, which we've just been keeping an eye on because it is it's largely consumer related, but also business related as well. And the report said that since the last report, economic activity had slowed. The outlook for the next 6 to 12 months had also diminished over the last month. They noted that price increases had largely moderated across districts, but remained elevated. So prices haven't coming down, they're just not going up as fast. Most districts see moderate price increases continuing into the new year. They also noted that labour demand continued to ease, and that consumer spending on discretionary items declined, and that consumers showed more price sensitivity. So again, just some little yellow flags being waved that things are demand, the economy, activity is just softening a little bit. Doesn't mean it's going to collapse, but just things are heading south rather than heading north. And as Kay mentioned, we had some other Fed heads out. Barkin was waffling, saying that revised consumer spending data is more consistent with what he's hearing on the ground, i.e. he's hearing that there's a bit of tightening in the consumer, that the consumer is slowing down but not falling off the table. Rate cut talk is premature, and he's still looking to be convinced on inflation. He's not willing to take another rate hike off the table, and wants the option of doing more on rates if inflation flares again. Now, we also had Mester out. She's one of the remaining hawks, and she seems to have jumped ship from the hawk boat. Said FOMC policy is in a good place to assess incoming data. The current Fed's funds rate positions the Fed well, and further hikes depends on the economy. She was previously going along with her baseline that another hike would potentially be needed. So she's eased off of that a little bit. Says there's discernible progress on inflation, but it remains above 2%. Broad tightening in financial conditions help curbs demand. It says the Fed must be nimble and respond to both sides of the dual mandate. So as mentioned, that the rowboat with all the hawks in, Kay, is getting less and less at the moment.
Yeah, This there's more and more dropping towards the line between hawks and doves. As I said, I mean, we should more talk about holders and folders right now. Yeah, the folders list start to get longer, and the hawks list is getting really short now. But you know, I mean, it's logic, right? We've talked about that. We are at the end of the cycle now. We are starting to look the other side. But now it's going to be a case of who's holding for longer than the others. But yeah, I mean, yeah, what's her name again? The other one, she's now really the only real hawk standing. We'll hear from Pavel tomorrow. I guess we'll talk about it then. He has the power to fight against getting too dovish. Perhaps send a gentle hint to Waller not to get too dovish, or Goolsby.
Yeah.
But yeah, I mean, the Hawks list is pretty much exhausted right now, and there's not many left. As you say the other day, even Nagel saying that it's starting to be enough. I think Holtzman at the ECB is one of the few still Hawks still really standing. Yeah, and that's what we are going to see into 2024, unless inflation flares up. But I think it's going to take a surprise of more than one print of higher inflation to make them change their view again, or add another hike. We can safely assume that we are done, and just going to depend on the timing now. As we've seen this morning, after that CPI print, I think they're now fully pricing in a cut by April for the ECB, and the total cuts is now priced in again. I don't like to use this word, but the market is it has put yields as low as to price in 115 BPs cuts all of a sudden, and that comes from how much? 75, 65 last week.
Yeah, and even less the week before.
Yeah, exactly. So it's really who is going to cut first, and then by how much in 2024. But what we do see, and that's been the case, if you look at the differentials, we've been running closely together between the European and the US somewhere with from a distance, but the differentials are not changing that much after all. If you look at the short end of the curve, of course, that is, which is the closest to what they actually decide on the interest rates in the monetary policy. So they are still running pretty much at the same rhythm between Europe and the US, which brings us back then to say like it's still only all one trade, you know.
Yeah, exactly. I think we also have to make the distinction that hawks jumping ship doesn't mean they're turning dovish. They're just moving to the fence where they'll collect splinters with all the other fence sitters. You know, it's something I always like to point out. You know, the market tends to be, if it's not hawkish, it's dovish. There is no neutral. There's no middle ground. But the hawks shifting doesn't mean it's dovish. It just means they're less hawkish than they were, or they're moving to neutral. Last headline, we've got OPEC meetings going on today. We'll see what mess comes from that. Overnight, there was a piece out from the Wall Street Journal saying that they're going to be potentially looking at new production cuts of maybe 1 to 2 million barrels per day, which would be pretty hefty if they get up towards the 2 million barrels per day. That's one of the reasons why you're seeing oil up a chunk today. It's coming a bit shorter across the different oil markets. So yeah, there's if they go that high, we could get a bit of a pop high on a confirmation of that. But otherwise, if it comes in less than that, under that, or if they just extend what they're already doing, we're probably going to see oil take a bit of a bath. But right now, after we've had that headline, I think the risk is two-way as to whether we pop up or pop down. But either way, I still expect a rally in oil to be hit because there's still the demand situation to deal with, and that's not improving. Sorry, mate.
Ryan?
Yeah.
We had a headline just at the start of the show, actually, saying that a delegate said that OPEC Plus has a preliminary agreement for additional oil output cuts of more than 1 million barrels per day. Didn't give any more details on the back of it, on that thus far, if I'm correct. I haven't seen if there's... and now, just 10-15 minutes ago, it says that almost all OPEC member states appear to be aligned that the deeper cut is needed. So they are talking about higher cuts. So that's why oil really jumped on. You're on the Brent, but okay. I mean, whether it's Brent or WTI is
yeah. I do wonder. People look at WTI, but obviously OPEC and stuff is all Brent oil. So
yeah,
really
yeah,
should be
yeah. I know.
I mean, it's all going the same way anyway you look at it. So yeah, it doesn't really matter which one you look at, but I like to look at Brent more so than WTI. So yeah, the expectation is there now. So if they confirm it, if it's to the high side, we probably would see a potential confirmation pop. But then it might be a case of buy rumor, sell fact, and then we get back to trading, as I say, the fundamentals and the demand situation and everything like that, which isn't looking too healthy. If you know that all economies are softening right now, that's never usually a boom for commodities like oil. So yeah, I'm still expecting perhaps we get a bit of a rally sell after whatever happens today. But let's see, there's plenty of time for them to mess all that up as they do in their ways over there in OPEC. Right, so let's get stuck into things. The first thing I want to point out, although yields have turned a bit now, is that this morning when we were getting all the inflation data, US yields were in the green, European yields were broadly in the red. We're talking about rate expectations and what's going on and who's cutting first and who's doing what. So we've had a couple of weeks of the US, everyone changing their expectations for the US, getting getting a bit ahead of themselves perhaps on the rate cut expectations. If you look at some of the bank forecasts, and now we've had this round of Eurozone data coming out, which is confirming that inflation is coming down at a hefty clip. So now it's the Eurozone's turn to have a bit of repricing of rate expectations. So really all we've done is pass the baton from what was happening in the US to what's happening in the Eurozone. It's just the market, doing its little bit of rate expectation changing in one area. Doesn't last forever, and then they shift their gaze to another area. That won't last forever. Then we'll find a bit of balance, and then we'll move with the data thereafter. But as far as the euro goes, we've probably seen some end of month stuff now washing out. So it's back to if it ain't supported on month end, then the only other way it can go is down. We have come down. We have hit the levels. We've gone through a few levels. We stopped briefly in the first dip down round about the 109.40 area, which was this on-off support resistance point. And then in the bounce, it became resistant. So this is our top side area to watch now. If we're going to see a bounce from here, it needs to get back over 109.35.40. We've also then hit the next level, 109.10, which again is just a bit of an on-off support resistance pivot level, whatever you want to call it, just ahead of the big figure. We've seen prior action there this week, last week. So no surprise it's paused there. So now we know we've got a bit of a battleground between there and 109.40. Get under there on 109, then it's looking like we're washing out a good chunk of this last couple of weeks move. Then we deal with the zone down here, the old zone down here. But if you look at it from just a bit of a wider perspective and take the whole 2-month move, if you like, as a whole, the 38.2 isn't down until 108. So it's still got a lot of work to do before it looks like we're going to start testing this trend at all. So we may be coming off quite a chunk from the highs, but we're not breaking down just yet. This could just be a pullback. Only if we start taking out the fibs, then we can think, okay, we've got a dip, maybe a trend change coming. So I would say don't get too excited that the euro has turned and we're heading back down to 105 or anything like that just yet. Price action needs to prove that. So me, I'm still long a bit. I won't be getting short at these levels. But if you're going to be getting long at these levels, you just need to keep it tight in case we are going to head a bit lower. Cable was doing a bit better this morning. It was holding up while the euro was doing its thing. But as you can see, it's also come off a bit. We're into this bit of traffic area here down to 126. So again, it is also not yet ready to give up. I haven't put a fib on this yet. I imagine that fib comes in some 38.2 fib of that move. Well, probably comes in around 125-ish or something like that. I just haven't got it on yet because we're too far away. So yeah, we've still got in the month to deal with the last day, the last fixes and everything else. So as Kay's been saying pretty much all week, you need to get over that hump then to maybe get a true picture of what's going on. So just keep that factored in. We'll see what happens at the fix. The world and his mate have probably been front running the fact that it's been a dollar sell in all the expectations. So maybe we're in that situation. Everyone's, as James in our chat room said, everyone's second guessing their second guesses and third guesses. So it's all up in the air. Wait until it's done and see what's what thereafter. Just one thing before I hand it over to Kay. Just wanted to know what's happening in the US 10s. Still bumping along the support here. This prior area that was resistance on the way up and then a bit of a pivot. So we're still holding the lows, not really bouncing. Still got this level to keep an eye on, 3.37, 3.3. That's our target there. Bit of a ping pong that we had 450 to that level. Now we've got it here between 424.25 and this level here. So again, if the dollar's going to move in any direction, it's likely to be because we've broken out one side or the other. Otherwise, we just may be seeing a bit of consolidation here for the dollar. Kate, you want to take it away, mate?
Yeah, and while you're on there, I just want to repeat that there was also a lot of talk about rebalancing in bonds and all that stuff. So even there, we will have to on the yields and on the bond side, we will have to, I guess, wait for the end of the day. I don't know exactly when the cutoff times are for when people can trade bonds same day. Because there have to be transfers done also. I know there's probably some cutoff times, but also there, I would like to really wait to make a decision, perhaps even to until after Powell has spoken, right? Because it's hard to make a decision here. Yes, we have broken under that 433, 34, 5 level, and it's looking negative. But how much is also end of month rebalancing in there? And I dare to think that that some of these yields have been depressed because the rebalancing needs were supposedly to go more into inflows into bonds. So that means higher bond prices means lower yields. So really, it's a bit of a messy month end. Yes, it was very clear until yesterday. And then again, the last day of the month, we're getting data out here. We're getting a bit of an extreme also there. Then we get a few Fed speakers, and we still have another 4 p.m. London fixing to come up, and then tomorrow Powell. So it's a bit of a dangerous one if you want to pick already a more medium term or so side. Although I find the European data bad enough to be short a euro somewhere against something.
It's pretty much the same for stocks as well, because I was thinking we might get a bit of a sell-off in stocks again on that rebalancing, but it's held up pretty well. I mean, right, we had a bit of a down day yesterday, but
it all started to happen yesterday, and then it stopped dead and back to where we opened basically the day, right? We're still hanging around there for 45.60 on the futures. So
it might be there for the dip buyers if we get a late splurge lower that looks a bit end of month, maybe down to I don't know, those low 45s, the 45 handle that might look a bit enticing. Just to play the other side, but we should see.
Or the other way around, sell it today and then buy it back later tonight, and then wait for what Powell has to say tomorrow.
Yeah, exactly.
So there's
many ways to skin the cat.
Yeah. Okay. I'm going to keep it short today because we really have this end of month ongoing. Just going to show a couple of things, and I just wanted to highlight again. This is the short-term differentials, okay? So we had this big dollar move. We had the seasonals playing full speed this month, actually more than other November months. I don't know exactly what the seasonals are for December, but it may be relatively similar or a bit less. But we overshot really the expectations for November on the seasonals. Dollar got hammered, bonds rallied, but then if you look at the differentials, we're still there, and it's the short-term euro, right? We're still there, and that's what makes me think that still the real data or data we should really be data dependent because we haven't picked a side yet on those differentials. Okay, so yes, we had the dollar move because the dollar is the biggest market, but unless this starts to really tighten up more, I think that euro has kind of ran its course right now, and then these lower European yields should eventually weigh on the euro in a certain way. Whether it be through crosses or really versus the dollar remains to be seen how strong or weak the dollar can be, right? So that is somewhere what I'm looking at. Just a few things. As I said already, I thought the sterling is one of the currencies that, based on equity moves at least, and on bond moves, but although they have been catching up a little bit, but on the bond moves side perhaps less. But sterling is one of the currencies that I expected to do pretty well over the month end. And we are getting a bit of confirmation about that. Okay, yesterday we printed a high on the cable. We also warned yesterday of saying, like, be careful, because sometimes we are doing the last real moves of the month end on the day prior to the end of month. But okay, we're still in a bit of a move lower here on the euro sterling, and I do think that there may be a bit left in this. I took some back of my positions on yesterday's fixings as planned, just keeping like a third or so open for today. But if ever I see it closer to 86 over the course of the day, I'm going to just take what I have and then run, basically, because I don't know what's going to happen, especially on the sterling side, when once December starts. And thanks to our good friend Bailey, who he really gives me the creeps. Thanks to our friend Bailey, he says that he's seen the worst in a long time in the UK. Perhaps the market will take notice of it when December starts. I don't know. We'll see the data. So this is the one. The other one, which could get very interesting today because of two reasons. Because of this OPEC meeting, Canada is always, well, it's been on and off the oil bus, but it's either forming bit of a flag here or so, or however you call it, for a move higher later. But on the day, there's a few calls, and then helped with our higher oils, a few calls for pretty sizable Canadian dollar buying as well. So perhaps this one is going to put this 148.5 to the test. We are on it, and if it comes down, we'll see over the next few hours how far it can take us. But it could be that there's a bit of room lower here. If we start in turn to get back above 149, figure 10, 20, then it's probably just like this flag pattern, and we continue higher. But based on what's happening in Europe, based on the expectations, this could weigh a bit more over the course of the day, really. You have to look at those metals, right? Because we're banging against this resistance here in silver, 25 bucks. Again, there, I would say, watch closely what's going to happen once the month end is over. If those yields continue to drift lower, metals should continue their path higher. Unless we get, for silver, unless we get real crappy economic data like recessionary data, then silver should underperform gold because of its industrial usage in silver. Gold 2050 is what I'm looking at, and on the way down 2030. So we're in about 20 bucks range here. I'm not tempted to do anything right here. I'm still long my long-term silver, but perhaps if gold come back on a retest here of the low 2000s after month end, depending on what Powell will say, this may be worth having a look at, providing those yields are not starting to completely reverse higher. Okay, those low 2000s. What else? Is anybody else want to look at something? I think you already covered the cable, right, Ryan?
Yeah, just briefly, mate. Yeah.
Okay. Yeah. So here we are rejecting on the Aussie. We really rejected. Okay. So this was the right time and the right moment level to take profits. We are rejecting. There's still some expectations to for dollar selling into the 4 p.m. fixings, but be very careful with what you do. I'm rather going to look at the other side now. If we get, for the reason of, the sole reason of, a move higher in or lower in dollar versus certain currencies, this one may be a candidate. Looking back at that CPI coming lower, this may be a candidate if we see an abrupt move this afternoon back up to 66.60 or so to try the other side. It's basically still one pot. The EM though has been doing much less well. I mean, if you look at this, the MEX really got a slap. Yesterday I was looking at this, perhaps to stop, but it just doesn't stop. MEX is really getting is under attack for the end of month. It's going to be interesting to watch this one once the month is over. But in the meantime, looking at the speed of the move, there is perhaps a case for this to go and retest 1770s or so, right? And the other one is dollar rand, really playing with my nerves, because I was hoping to buy it lower towards the end of the month, but it's already banging its head, banging against or coming close to resistances here, 1890s, 94, 95. Watch this one. If it starts to break into the new month, this dollar rand has likely further legs. I still would like to see a retracement though to get back into it. And
dollar Swiss quickly,
dollar
mate.
Swiss. Look at dollar Swiss. The dollar Swiss, yes, because it's one. You know, the Swiss was one on my radar because the Swiss franc was also one that I expected to do well. Sab, and we could see some further Swiss strength. If you look at Euro Swiss, if you look at other crosses, the Swiss franc is still doing well. I think it could last until the afternoon, and then we reassess. If we get a bit of a spike lower, I'm also looking at counter trading it. You're long at 87.40. Your risk is for a spike lower, and I don't know where it can go if there is still stuff to do for the 4 p.m. But I do agree on the direction. Okay, I'm more looking at getting in if it gets closer to 87, perhaps. But I may miss that boat. It's okay. I'm already short euro dollar, but let's see. Back over to you, Ryan.
Thank you very much, mate. I think we'll call that a session for today. What have we got? Just have a quick look. I don't even know what's coming up this afternoon on the calendar. Jobless claims PCE data. That's for October. So it's the new month. We're into Q4 stuff. So there's no reflection on what we got from the GDP data yesterday. So that's going to be our thing. It tends not to be as big. I know it's the Fed's preferred measure, but the market's already moved on the CPI numbers, and this usually follows in a similar pattern. So unless there's some real big shocks from that, then I can't see anything major from that. But again, a lower number than expected will just confirm that the trend is still lower for inflation, and we might see a bit of a dollar sell-off again. But watch those 10-year yields, whatever happens over the PCE. If it holds the range, then we're probably not going anywhere far. And then from that, we got Canada GDP. So something for you loony traders to get your teeth into. Anyway, that's that for today. Thank you very much. We're nearly at the end of the week. Stay safe, stay warm, get your snowshoes on. We will see you all tomorrow. Thank you very much. Cheers, Kate.
Cheers, Ryan. Thanks, everybody.